Welcome. Thanks for joining us today for part 3 of our 4-part series on tax planning. Today we are discussing tax efficiency solutions. I'm Whitney Roseborough, one of the marketing coordinators here at Squire. A couple of things before we get started. If you look in the Q&A section, you'll see a couple of announcements. I've posted a link to the final session of this series, which will be held in 2 weeks if you'd like to register for that. We also have, starting this Monday, a new webinar series on PPP forgiveness. There is also a link to sign up for our monthly email newsletter, which includes the latest accounting news, as well as updates and announcements for our upcoming events and webinars. Now, let me introduce you to our awesome presenters today. We have Doug Flake, Julie Anderson, and McKay Lindsay. Doug is a CPA and tax partner here at Squire. He enjoys working with clients in estate and tax planning, business ownership succession planning, and resolving complex taxation issues. Julie is a CPA focusing on businesses and partnerships. She is part of our Squire Wealth Advisors team, helping people meet their financial goals. McKay is a CPA and an advisor with the Wealth team here at Squire as well. He is also a senior in our tax department. McKay enjoys working with small business owners. And with that, we will get started. Take it away, Doug.
Okay, thank you. Can you hear me all right?
Yep.
Okay, good. So Whitney has a really good newscaster voice, as you just heard there. That's only one of the reasons why she's good at what she does. But I don't quite have that voice, but I'll kind of plug away and go through here as well. So we are talking today about tax efficiency solutions. I'm going to talk about how tax efficiencies can be structured in merger and acquisition transactions. Julie and McKay will follow me with other areas of tax efficiency. So when you go into a merger and acquisition transaction, here we go. Okay, first section here. So the goal here in a merger and acquisition is, first, you want to make a good economic deal. So the economics of the deal overall and the taxes are related in that taxes are a subsection of the economics of the deal, but the taxes need to take second priority. The first deal is make a good deal. If you're the seller, you actually want to sell your business for as high a price as you can generally. There's a lot of other factors you'll consider as well, such as you want your business to survive, you want your employees to be taken care of, and everything like that. So we're talking about the tax, which is a small part of that. But keep in mind that the best tax structure is not going to turn a bad transaction into a good one, but it can improve the transaction. Now, the tax structuring of a transaction would be simpler if you knew things far in advance. If you knew your exit plan, well, and not just your plan, if you knew your final exit strategy years in advance when you're setting up the company. If you knew things like the sale date, the sale price that will be paid, and the buyer information, such as who's your buyer, what industry, how are they structured, how big are they. All of those are things that could help you in setting up your company. Where you don't have that, then it's kind of nice to have flexibility to the extent that you can. I'm going to talk about the tax structure of a sale and a purchase from both the seller's and the buyer's side in 3 different types of entities. I mean, the basic 3 business types. We have a CCorp, an S corporation, and an LLC. I know there are other structures like that, but generally the tax structures will fit into one of those 3 for most operating businesses. So I'll talk about that. Now, many operating businesses are structured for a lot of good tax planning reasons with separate entities. For example, you might have an operating corporation with an LLC owned by the same owner or group of owners which holds real estate or other appreciating assets, that can be leased by the operating business. So the things that I'm talking about, I'll just go through these different sale types as if it was one business being sold, but in fact, in many cases, there will be both a corporation and an LLC to sell. And there are different things we can do to be efficient on both of those. So to start out, let's look at our tax goals. And again, these tax goals come after we've already made the best economic deal that we can. So the seller's goals is to pay as little tax as possible. They can do that by qualifying for long-term capital gain rates in many situations. They also want to maximize their basis recovery. Obviously, they want the highest price possible, and with the sales price possible, and with the highest sales price, you're going to have more gain. But if you can maximize your basis recovery, whatever basis you have, take as much of that as early as you can. That's going to reduce the gain that you're going to pay tax on. And then if you have a deferred part of the sale, this could be a rollover, it could be an installment note. The seller generally desires to defer tax on that part of the sale that isn't paid to them immediately in cash. The buyer's goal generally is to maximize their future deductions from owning the business. And this is a tax goal. Again, keep in mind the buyer wants to get the best business they can, the best future tax flow possible, the best future cash flow possible, but they also want to be able to take their tax deductions as quickly as possible. And there's ways that the buyer can structure to do that. So to start out, I'm going to talk about a C corporation. So in each of these entities, a C corporation, S corporation, LLC, I'll talk about an asset sale, how that is treated, and then I'll talk about a stock sale or an equity interest sale there and how that'll be structured. So with a C corporation in an asset sale, the seller is generally going to be double taxed, and the rates can be prohibitive. As of right now, with today's tax rates, this is the 21% C corporate internal tax rate, the 23.8% dividend rate on individuals received. The double tax would approach about, with federal only, would approach about 40%. If you add states into that, that's probably going to add 6 to 8% there. Well, it depends on the state tax rate. But with double tax, an asset sale in a C corporation can be pretty expensive. Generally, a double tax on a C corp sale is going to be higher than the individual level tax that you get with pass-through taxation with an S corp that you'd get with an S corporation or C corporation. So generally, a C corporation seller, a seller who owns a C corporation, is going to want to avoid an asset sale and go with a stock sale, but that depends on your negotiations as well. The buyer coming in generally wants to avoid a stock purchase for a few reasons. One is that the stock, if you buy the stock, you're acquiring all of the unknown liabilities of the C corporation that you're bringing, or whatever entity you're bringing. If they get sued by a customer, for example, or by anybody, then the buyer might inherit the liabilities associated with that lawsuit. And another reason there is that, as kind of talked about here on the bottom part of this, the buyer who gets stock, and this is actually on the next page, but the buyer who gets stock isn't able to deduct anything immediately, where a buyer who buys assets can usually recover the cost of those assets. If it's inventory, they can sell the inventory and write off the cost. If it's depreciable assets, they can set up and depreciate those assets, so they can take advantage of bonus depreciation. Even if it's goodwill or intangible assets, the buyer can usually depreciate those. If they're buying in an asset transaction, they can usually depreciate those intangible assets, and a lot of times they'll have a life of about 15 years. So there's the double tax. There's not a preferential long-term capital gain rate in a C corporation. That was actually a pretty big deal back in 2017 and earlier, when the C corporation rates were as high as 35%. Now the C corporation rates are only 21%, so the lack of preferential long-term capital gains rates is not as bad, but it could be important in the future. With the new administration coming in, there's been a lot of talk about increasing taxes. So that 21% that we now have in C corporations may or may not be around for a while there. Now, one significant thing I want to talk about is this 1202, the section 1202 qualified small business stock. In a situation where you can plan to make use of that, that can be extremely powerful. What that does is it can eliminate all of the tax, all of the shareholder level tax. It does not eliminate the internal tax that the C corporation pays, which is right now 21%, but it can eliminate the capital gains tax that would be paid by the seller. And that can be extremely powerful. Now you have to fall into a situation where 1202 applies, and generally it means that the stock the seller is selling was acquired originally from the C corporation, and at the time it was issued, the C corporation had less than $50 million in assets. So in most small businesses I mean there's a lot of room in that $50 million. That's a pretty high amount there. So. And if you can meet that 1202 qualified small business stock, now that doesn't mean that your maximum sales price on the business is $50 million. The business can sell for more than that, but it has to have had $50 million in assets or equity issued as of the time of the person acquired the stock. It also has to have been held for 5 years and acquired after 2010. That's a few of the things there. So, but that can be extremely powerful if you can negotiate a stock sale. It's even more powerful if it's powerful in an asset sale, the 1202. It's even more powerful in a stock sale. Now, with an asset sale of the business, the buyer can set up the business in whatever entity they desire. That'll probably depend on the size of the buyer, the industry they're in, and what's kind of the normal for them. And with any asset sale, the buyer and seller agree on the value of assets and report that to the IRS with a form that both of them file. It's a Form 8594. They both file, so you want to make sure that the buyer and seller have that coordinated when they send that in, because the IRS will compare that. They will cross-reference the client, the EINs, and the business identification, which is reported right on the form. So in a C corporation stock sale, that's actually a good thing for the seller, because even if it's taxable, the seller gets long-term capital gains treatment, which is going to be preferential at the individual level. And if they can qualify as a 1202 qualified small business stock where they get that 0% rate, they may avoid tax altogether, and that can be extremely powerful. On the buyer's side, where they can, if they're buying assets, they can deduct the sales price. On the seller side, or on the stock sale side, the basis is tied up in stock and they don't have the ability to deduct or depreciate that. And that may limit the price they're willing to pay. Sometimes the buyer, if they don't get tax deductions, is going to offer something less. So the negotiations there depend quite a lot. And that'll depend on the type of buyer you have, the size they have, maybe whether they're publicly traded. It seems the bigger the buyer, and if they're playing in a public arena, they may not be as worried about the disadvantage of buying stock sometimes. But in the smaller arena, with private companies, that can be a pretty big deal. Now, in a stock sale of a C corporation, corporate attributes will carry over to the buyer. Corporate attributes are things like net operating losses, and there's certain other types of positive carryovers, but the values can be limited due to the stock ownership change. So if a buyer's coming in and buying a C corporation for next to nothing, then those NOLs may not have much value to the buyer. Going into an S corporation, if it's an asset sale, so an S corporation doesn't have any entity level tax and only has individual level tax because it passes that all through. There's no double tax, and the gain can be ordinary or long-term capital gain depending on the value and the character of the assets being sold. There's a residual allocation that'll take the goodwill, that'll post the rest of goodwill and tangible assets, which for a lot of sellers are going to be treated as long-term capital gain assets, and so that's a good thing. Here again, the buyer can set up on an asset sale, can set up the business in whatever entity they desire, and they both agree on the value of the assets and report that on the form 8594 to the IRS. And the stock sale of an S corporation, the seller gets long-term capital gain treatment. We don't have the 1202 qualified small business stock in this situation because an S corporation does not qualify. Stock in an S corporation does not qualify as 1202 stock, and it's got to be a C corporation. The buyer's basis is going to be tied up in their stock if they buy the stock. They don't have any ability to deduct or depreciate. Now, if the buyer continues the corporation as an S corporation, they will have that basis in the stock. They can take pass-through of their losses, and they'll eventually recover that on a sale of the business, but they don't get any deductions for that. An LLC or partnership, it's similar here. On an asset sale, there's no double tax, and the gain can be ordinary or long-term depending on the value and character, and the same residual. And then really this is kind of the same situation as an S corporation on the other things. If it's a membership interest sale, the hot asset sale can give ordinary income to the extent of the LLC's hot assets, even though this is a differentiation from an S corporation stock, which doesn't have a hot asset pass-through. Hot assets would be those things that would generate ordinary income, things like unrealized receivables. If you're a cash method business, then when you sell your receivables, that will generate ordinary income. You also have depreciation recapture to the extent of any gain on tangible and intangible assets. And if you have appreciated inventory, that will generate ordinary gain. So in a liquidation of a C or an S corporation, the assets are treated as sold for fair market value and gain is recognized by the corporation. I'm going to skip over this a little bit so I can cover a few last slides since I'm kind of running out of my share of time here. I wanted to talk about partial sales or rollovers. It's not really uncommon, not very uncommon at all, for sellers to retain some ownership in the business after the purchase. If that's the case, then their basis is going to be allocated between the stock or the membership interest they've sold and the portion retained. They usually want to structure that so they can do that in a tax-free way. If I have a $10 million business, I'm selling $4 million of that and retaining $6 million. I don't want to pay any tax on that $6 million that I'm retaining, and there are usually ways that you can structure for that. A common way is a non-taxable contribution into an LLC or a partnership. Assets can be contributed by the seller into a partnership without triggering tax on appreciation. Now, it does affect the allocation of depreciation deductions and future gain on sale of the business. We'll take that into account, and so the gain will eventually come back, or the reduced deductions will eventually come back there. But it's still overall a beneficial thing to avoid tax on that structure at that time. There are a few ways where stock can be sold or acquired in a corporate merger without recognizing tax on that as well. And that's what I have there. I'll turn the time over now to McKay to talk about tax efficiency and investments. If you do have any questions that come up, I'd be happy to, we'll all be happy to talk about those later. McKay, go ahead.
Thanks, Doug. So just wanted to talk about tax efficient investing. So first topic I wanted to discuss was tax exempt investments versus taxable investment options. So some of the tax exempt investments you're probably familiar with are U.S. government bonds, and they're only tax exempt at the state and local returns. They're still taxable on federal returns. And then muni bonds. Muni bonds are kind of the opposite. They're tax exempt on the federal return. In some instances, they're also tax exempt on your state return. Typically, if you get that tax exempt treatment on your state return if the muni bond is issued by your home state. Although some states do have agreements with other states where they agree not to tax muni bonds from each other states. So Utah, for example, has reciprocity with a handful of other states. So that might be something worthwhile to look into. before you buy a muni bond. And then you have a couple of tax-exempt investment accounts. So I'm sure you're all familiar with Roth IRAs and Roth 401ks. So those are accounts, they're not actually investments. So you buy investments inside of these accounts, and the growth is not taxable. And then when you take a distribution from these accounts, it's also not taxable. However, the contribution, so the money you put into the account, is after-tax dollars. So those can be a great benefit. You're probably familiar with HSAs, health savings accounts as well, which are unique in that they actually offer a triple tax benefit. So when you make a contribution into these accounts, you get to take a tax deduction. All of the growth inside of the account is tax deferred. And then when you pull money out, take a distribution to be used for qualified medical expenses, you don't have to pay tax on that. So those are some incredible benefits that you could look into taking advantage of. So moving on, Doug, to the next slide. So what are the taxable investments? The ones you're probably most familiar with are stocks, mutual funds, corporate bonds, exchange traded funds, and options. So basically everything else falls into this category. So you're probably asking yourself, why would I ever buy a taxable investment if I could buy a tax-exempt investment? The answer is it really depends on your situation. I know that's not the answer most people like to hear, but Doug, if you want to advance to the next slide. The situations in which it might make more sense to buy a tax-exempt investment is if you are in a high tax bracket. And the reason being is that tax-exempt investments usually have lower expected returns than taxable investments. And so if you're, let's say, in the lowest tax bracket of 10%, it might not make sense to buy a tax-exempt investment because you're only saving tax at a 10% rate, rather than if you're in a 37% bracket, for example, even though you may have a lower expected investment return, the tax savings might make it worthwhile to pick a tax-exempt investment in that case. So really, you just need to do an analysis of the after-tax returns to help you make the best decision on which investment would meet your goals the best. Next slide. So one of my favorite areas about to focus on is asset location, which I think can pay big dividends in doing investing tax efficiently. So what you want to do here is you want to make sure you're owning the right investments in the most tax efficient accounts. So just a quick example. Let's say you have a Roth IRA, a traditional 401k with your current employer, and then you have a taxable individual brokerage account. And so when you have, and let's say you have your investment advisor, he helps you determine what your asset allocation should be, what investments you should focus on. Now you just need to know which accounts you want to own the investments in. It might make most sense to own small cap stocks, for example, which have generally historically had a higher expected return in a Roth IRA, because the growth inside of a Roth IRA is not taxable and the distributions are not taxable. And so it makes sense to put investments that have a high likelihood of growing the most inside of your Roth IRA. And maybe you have a portion of fixed income in your portfolio. It makes sense to put your fixed income in a traditional account, so like a traditional IRA or traditional 401k, because fixed income generates interest income, and interest income is taxed at your ordinary income rate. And when you take a distribution from your 401k account, it's ordinary income, tax at your ordinary income rates. So you want to match up the ordinary income producing investment asset with the accounts that generate ordinary income distributions. And then lastly, your taxable individual brokerage account. It would make sense to own assets in there that generate income that qualifies for long-term capital gains. So let's say stocks and mutual funds, for example, paying dividends, qualified dividends where you can get the preferential long-term capital gain treatment and pay less tax on those. So you definitely want to pay attention to where you're holding your assets and what types of accounts. Next slide. So gain and loss harvesting. So might be easiest to explain in another example. Let's say you buy an investment at $10,000 and then over time it drops down to $5,000. So at this point you haven't necessarily, you've experienced an economic loss, but until you sell it, you don't get a tax loss. So let's say you look at your tax situation and you decide that you want to harvest that loss. So you sell it at $5,000 and you take a $5,000 tax loss. And then at that point, you can either keep it in cash for 31 days. If you buy that same investment you sold within that 31-day period, it's called a wash sale, and it negates the loss that you harvested. So you won't actually be able to claim that. So you have to wait at least 31 days. But a lot of times you don't want to be out of the market for 31 days. So what you'll do is you'll buy a replacement investment. So it can be similar, but it can't be substantially identical to the original investment. So let's say you buy that replacement investment and then the market goes back to $10,000. So economically, you started with 10,000 and you're ending with 10,000, but for tax purposes, you harvested a $5,000 loss. Or if you hadn't sold when it dropped, you wouldn't have been able to take that $5,000 on your tax return. So that's called loss harvesting. And then similar, but just the opposite is gain harvesting, if you want to go to the next slide. Gain harvesting, just like it sounds, is when you sell an investment at a gain. So say maybe you have a lot of built up capital losses that you want to use because they're only limited to 3% if you don't have capital gains to offset them against. So maybe you have a lot of built up capital losses that you want to take advantage of. So maybe you sell your investments that have large gains so they can be offset by those capital losses. Or maybe you have a low income year. Maybe you just retired and you're not receiving your W-2 that you were used to receiving and you haven't claimed Social Security yet. During those low income years, it might make sense to sell some investments that have been doing well to harvest those gains and only be taxed at the lower long-term capital gain rates. And then last slide about gain loss harvesting. You can only do gain loss harvesting in taxable accounts. So if you're thinking of doing this in your IRA or your 401k, it won't work. You don't actually get to take losses in those accounts. It has to be in a taxable account. So an individual brokerage account or a joint account that you have set up with your spouse. And then I'll turn the time over to Julie to talk about tax credits.
Thanks, McKay. So yeah, we wanted to touch on some tax credits. The first webinar that we did touched on business tax credits. So these are more individual tax credits and some deductions. And just to review what a tax credit is, so a tax credit is going to be a benefit, a dollar for dollar offset against your tax liability. And then some tax credits can even be refundable. So if you have enough credits to wipe out your tax liability, some can actually even just pay you that extra money, that additional amount above your tax liability. Versus a deduction, a tax deduction is an offset against income. So if you have income and then have a deduction, that just decreases your overall income. And then you would still apply the tax rates to that to figure out your tax liability. So just to distinguish that. So credits are usually better. The first one that we're going to touch on is the child tax credit. And this is for if you have children that are your dependents and they're under age 17 at the end of 2020, that credit is $2,000. And that's an increase from $1,000 from the Trump tax laws. And so that's great. The other benefit is that the phase out really jumped up. And so that doesn't start phasing out until married filing jointly, you have income of 400,000. So a lot more people have been able to take this credit. And so that's a great benefit that came from those tax law changes. The other tax credit for benefits is for qualifying dependents other than the qualifying child, which is the tax credit up above. So if they're age 17 or older and you're still, they're still your dependent, or also a dependent, caring for an elderly parent is another example. That credit is $500. And again, that they are subject to income based phase out as well. But those are the two main credits that we have for dependents now. Next slide, great. And now if you're paying dependent care, there's a credit for that for children who are under 13 or other qualifying dependents. And basically that's, you pay your dependent care expenses, and part of that then expense turns into a credit. So for one child, it is 20% of the first 3,000 qualified expenses for that child. If you have 2 or more children, then it's 20% of up to 6,000 of qualified expenses. And so the maximum credit for that is usually then $600 for one child or $1,200 for 2 or more children. Another idea for if you're paying dependent care is to actually do it through a flexible spending account. And so right now is a lot of the time where there's open enrollment for people signing up for insurance plans. And if your employer sponsors or gives you the option of a flexible spending account, this is probably something you should look into, because you can contribute up to $5,000 and have that go to pay for child care expenses, or either the plan pays it or you're reimbursed. But with that $5,000 limit, it is pre-tax, and so you're never taxed on it. And so that's a great way to be able to pay some of those child care expenses. But just note that then if you do it through your flexible spending account and do it pre-tax, then you can't also take the dependent care credit. It's just one or the other. Okay, next slide, Doug, please. Okay, one thing we wanted to mention too is 529 plans. So this is a great way to save for education. And their contributions aren't deductible for federal tax purposes. There's some states that have small benefits, but again, not a huge benefit as you put contributions in. What the purpose is to have that grow tax deferred. And so then when you take distributions from that 529 plan to pay qualified school expenses, then it's typically tax-free for both federal and state purposes. So some examples of qualified post-secondary school expenses are listed there. So you've got tuition, mandatory fees, books, supplies, computer equipment, software, internet service, and room and board. And then a couple new features that have been added on: the elementary and secondary school tuition of up to $10,000 per year per student. And then also it can be used to pay up to $10,000 of student loans per beneficiary. So those last two bullet points are relatively new and can provide great benefit too, for not just college education type expenses. Okay, next slide, Doug. We wanted to also talk about the American Opportunity Credit, and this is for people going to school, or your dependents going to school in the first 4 years of post-secondary education. And this is a credit that gives you a $2,000 credit for the first $2,000 of tuition and related expenses. Then the next $2,000 of tuition and related expenses, you get a credit of 25% of that. So if your student has more than $4,000 of tuition and related expenses, you would max out that credit and at $2,500. And it's available for the first 4 years of the post-secondary education. Now there are income phase out for this as well, and you can see there it says it's starting married filing joint starts at $160,000. Now if your student or yourself, if you've already been through the first 4 years of college, then there's the lifetime learning credit that you can take advantage for education expenses. And what that credit is 20% of the first $10,000 of qualified higher education expenses. And that is maxed out at $2,000 per tax return. So it's not a per person $2,000 amount. That would be a combination of, a taxpayer, so husband, wife, and any dependent children. All together, they could only take up to a $2,000 credit on their tax return for that. And that also phases out for married filing joint at $118,000. Next slide, please. Okay, and so lastly, we also wanted to point out that there's a tuition and fees deduction. So sometimes the circumstances might be that you're actually better off deducting your education expenses rather than taking a credit. And so there's a deduction up to $4,000 for the higher education tuition and fees, and that also is phased out at $130,000. So those are kind of the main credits for individuals that we run into and want to make you aware of. So I think Whitney will turn the time over to you.
Great, thank you guys so much for attending our webinar today. It doesn't look like we have any questions. Just for a reminder, I will be emailing out a copy of the slides as well as a video of today's webinar to everybody attending. Be sure to look out for that, and we will look forward to hosting future webinars. Thanks.